with us for the next month. I think it's really important to start the year off good, and it's nothing better than a bit of discipline that you are almost forced to join us every day for the next 4 weeks. So what we're going to be doing in this first session is really taking everything back to basics. What we try to do at Serene Education is at the start of each year, things that have happened during the year before, people have started to make their charts way too complicated, and you start to see people starting to mess up towards the end of the year. So by taking everything back to basics again, we're going to start from the grounding and we're going to build it up over the course of this month. So with our Forex Made Easy, that's exactly where we're going to start. We're going to discuss a little bit about creating a plan tonight. We're going to look at each of the indicators and how they work in relation with price and how we use them to come to a conclusion on whether to take a trade or not. We're going to look at putting it all together through analysis. Chris will do the 4 majors, but going through the step-by-step process on how we use Forex Made Easy to get a final outcome. And then we're going to have a look at pairs that you would like to discuss. For those of you who have been online with us today, the markets have not been that great. We're getting to see a lot of movement, but it's counter trend. And on other pairs, a lot of consolidation. So hopefully during the course of this evening or this afternoon, things have moved a little bit more in our favor, so we've got a little bit more to discuss. But Mondays are generally the dull days, so hopefully from tomorrow in our morning session, we'll be able to pick up a lot more things. So let's have a look at the basics of starting and creating your plan. Now I want you to think about things like, when will you be online with us? In the forum, be able to participate with us, to ask questions, to do analysis with us, because the more time that you can spend in that room, not only with Chris and myself, but with everybody else that's within this program and outside of it, it's really going to be a benefit to you. Then you've got to think of how much time you are willing to allocate towards your learning and your trading. Now, it might, just because you're doing this course, be an hour a day, the hourly sessions that you spend with us. But again, put that into your plan and make sure that you stick to that. How are you going to analyze the market? Some people just jump in straight in the time frame that they want to trade. It's not really the correct way. We're going to explain that as well. But you've got to have a look and determine and write down the step-by-step plan that you're going to take in order to get to that final conclusion on whether to take the trade or not. Then you want to determine your risk percentage. Are you willing to risk 1%, 2%, 3%? People trading with very, very small accounts, you can trade 1%, but you're not going to see that huge amount of profits coming through. So some people do allocate 2 or 3%. So it's got to be within your safety net and what you're comfortable with trading. So that's something that you need to decide for yourself based on the capital that you have in your current account. And then the trading psychology side of it. How are you going to manage your emotions? Once you're in a trade, I know we get a lot of emails and calls coming through, people panicking because they've entered into a trade. The trade has now changed direction on them. And that is the hardest part of trading. You can have the best strategy, the best education, the best everything. But if you don't have a good trade psychology, that's where everything starts to fall apart. So, the best thing that I can suggest is if you enter into a trade, walk away. That's the easiest thing. You won't see it going into the negative. You won't see it going into the positive. We've got to understand that the market is going to go up and down. So our profits are going to go up and down as well as price moves within that trend. The other thing that you can do is get to understand yourself and the fact that you have done your analysis properly, you've stuck by the rules, and you followed your plan. If the price goes against you, it's just bad luck. So those are the type of things that you've got to take into account as well. And then, of course, the last part, how do you manage your trade? A lot of people are starting off this year saying that they're just going for 20 pip profits. That's all that they're looking for. 20 pips on every single trade, which is fair enough. That is one way of looking at it. The other way might be that you're going to try and look for the bigger moves and manage your trade day by day, moving your stops as you go along. So these tiny little things, when you put them all together, creates a great trading plan. And it's something that you need to write down, and it's something that you need to stick to, and and something that you need to follow. So this is what we're going to be looking at throughout the course of this week, especially. I'm going to be asking you a couple of questions based on what I've just discussed already. So let's get started with Forex Made Easy. I know some of you have already used it before, some of you might be new to it, some of you might have seen it many years ago and needing a refresher. So we'll just start off with the two moving average lines. So we've got our 50-day moving average and we've got our 200-day moving average. Now, our 50-day moving average is going to determine our medium trend direction. So what I mean by that, if price is trading below the 50-day moving average, the medium-term trend of that particular currency pair is down. If price is trading above the 50-day moving average, then the medium-term trend is to the upside. So very quickly and visually, we can see that medium-term trend. Then we've got our 200-day moving average. Now, this is our institutional moving average. It's our major long-term trend. So again, if price is trading to the downside, or the bottom of the 200-day moving average, the long-term trend is down. And if it's trading to the upside of the 200-day moving average, the long-term trend is up. Now, the idea of looking at it in this way is because ideally what we're looking for in order to put more eggs into our basket is for price to be trading in the same direction, medium and long term, because otherwise we could be counter trend trading, which I'm sure that you have seen today. There's been quite a lot of those opportunities. So by looking at that, that's giving us one way that we can use our moving averages. The other way to look at moving averages is for support and resistance. A lot of the time you'll see price uses the moving averages as a support or a resistance. So if price is trading into one of these moving averages, then we need to take caution because it could stop and then change direction there. So it's like a ball hitting a ceiling. Okay, we don't know how strong that ball is going when it hits that ceiling level, whether it will break through it or it will bounce back down. So that just gives us a little bit of a warning if we do see price trading towards a moving average. The other way that we look at it is the moving average crossovers. So here you can see that we've had a crossover of the 50 and the 200 day. Now, what is happening here is that the 50-day moving average is crossing the 200 day. So now the 50-day moving average is closer to price than the 200. Can you see that? We've got our 50 and our 200 and price is below that. Now this confirms that we are in a stronger trend, so a stronger trend to the downside when we've got that happening. We see back here, we had price trading below the 50 and the 200. We saw it pull back and price fell from there. So it's starting to give us there the confirmation that we are in a stronger downward trend. We can also look at the fact of the distances between the 200-day moving average and the 50. The further apart they are, the stronger the trend is. Now, if you picture pouring concrete in between those two lines, the thicker it is, the stronger it is. So with price getting further and further away and the moving averages getting further and further away from each other, it's becoming stronger and stronger for price to break it. So that's moving averages. Gives you so many different dimensions on how to look at it. Remember, trend direction, support and resistance, and the strength of that trend. Now we'll pop down onto the bottom one here, onto RSI. Now, RSI stands for Relative Strength Index. We've got our midline, which is based at 50, and then we've got 70 and 30 on either side. Now, the simple way to read RSI is we want to have a look and see where our line is in relation to the 50 level. If RSI is above 50, then it's said that the trend is to the upside. If the line is below 50, then it's said that the trend is to the downside. Now remember, when we're trading, we're looking for trend direction. We want trend, we want strength, and we want momentum. So this is why these indicators have been put together to form a very simple and easy to use strategy. We've then got our 70 level. Now, if our line goes into the 70 level, it means that price is in an overbought area. Okay, so there's been a lot of buyers in the market and it is now in an overbought area. It doesn't necessarily mean that price will change direction. It just means that there could be a potential for a change in direction. So again, it's looking at putting eggs in your basket. If our line is above 70 and we are trading towards a support or resistance level, we need to take more caution as to not take that trade until such stage it's in a better position. If the line drops below 30, it's the same thing. It is now in an oversold area. Again, it doesn't necessarily mean a change in direction. However, it does mean that there could be a potential pullback coming into play. So that's RSI, putting it very, very simply. And that's all we're trying to do at the moment. We can complicate things a little bit more, maybe in week 2, but just reading the strategy, how it is, and the indicators as how they are, we're just going to be looking at RSI to be above 50 or below 50. And the last indicator that we're using here is our MACD. Now with MACD, you can get different versions. We had ours done, so we had the moving average lines included in it as well, because it allows for different levels of entry. So the first thing we're going to look at, the most obvious, the histogram. Okay, we've got our midline based at 0, and if our histogram is above that midline, then it is said that the trend is to the upside, and if it is below, the trend is to the downside. So that's just basically looking at trend. Is it bullish or is it bearish? The next thing we look at our histograms. Are they getting bigger or are they getting smaller? So by seeing our histogram bars going from small to big, we're starting to see more momentum coming into the market. So we've got our trend. Now we're looking for that momentum. So what we're going to be doing is looking to enter into trades when those histogram bars are growing in size. We don't want to be entering into positions, for example, into a sell position when the histograms are getting smaller, because it's showing a weakness in that trend, which we saw back here. So let's put that back into perspective again. Our histogram bars are above for bullish, below for bearish. And we're wanting to see our histogram bars growing in size to give us that momentum coming through. The next two things that we've got within our MACD are two moving averages. Now, these are called the FOST line and the trigger line. The FOST line is the green line. You will always see it cross the midline first, and the red line being the trigger line. Now, the same thing that we mentioned with the moving averages and moving average crossover, it gives you a potential change in direction. So if we're seeing here, we've got our FOST and trigger lines are below the midline. Okay, so if they're below, it means that the trend is more negative. However, when the FOST line crosses the trigger line, it gives us an indication of a potential change in direction. Okay, it doesn't mean that they necessarily will be, but it's warning us we would not want to take a trade when we start to see this setup in play. Because look what happened, it found a support on the 200-day moving average and it bounced higher off that. Here we can see we had a moving average crossover here. Our green FOST line crossed through the red line, and what happened? Price fell. So these are different things that we can use. Now, in terms of the strategy in itself, in order for the MACD indicator to be set up nicely for us, we're wanting our MACD histogram to be above the midline, and we're wanting our FOST and trigger line to be above the midline as well. Now, that's a very passive entry. Now, I know a lot of traders are not all the same. I'm very much more aggressive. Chris is very much more passive. So depending on, how you want to work the market and read what's happening within the charts, that would be a very passive way to do it. The medium way of doing it is by having a look, getting that moving average crossover, your histogram above the midline, and your FOST line having crossed the midline. Okay, remember the trigger line is going to be very much slower. It's going to take a little bit more time in order to cross the midline, and therefore another option would be to get that histogram above the midline and the FOST line crossing the midline as well. So that would be the next way. And a very, very aggressive way would be to wait for that moving average crossover and wait for the histogram to be above the midline. Not waiting for the FOS line, but making sure that we've had that change in direction and the trend and the momentum has gone to positive. That could be another alternative. So there's three different ways that you can look at using MACD to enter your trades based off your personality. If you're very aggressive and wanting to have a look at things sharply, then moving average crossover and MACD histogram above or below. Less aggressive, we're going to be looking for the MACD histogram and the FOS line to be above or below. And for a passive, we're going to be looking for the MACD histogram, the FOS line, and the trigger line all to be within the same area, giving both strength and trend. So those are the three principles: our moving averages, our MACD, and our RSI. That's as simple as what we're going to keep it. Now, in terms of things that we need to add to our charts, for those of you who've been working off FX Ultimate, you've had the luxury of all your support and resistance lines automatically placed in. This is going to bring you back to thinking about changes in price directions, major support and resistance levels, ones that really get your eye. So this is the way that I look at it. I will always put in a line, a support and resistance line at any moving averages that I have on my chart, because that's what they are. That's one of their principles. They are support or resistance levels. So straight away there, I can see that price is trading towards a resistance level, and then would determine, if there was enough left within the trade, as long as those indicators were set up. Now, having a look, you can see I've drawn in that line at the moving average, but can you see, look here, there it acts as a resistance, and here it acted as a support. So it's a long-term support and resistance level, and those are the levels that we're looking for. A place where price has traded along for a period of time and bounced off it. If it's touched it just once, it doesn't necessarily mean it's a strong support. The more touches that it has, the stronger it is. And we can see here the 50-day moving average level that I stuck in. Can you see the strong support throughout here? So again, another strong support and resistance level. So these are the things that we're going to be doing now. We're going to be doing for the next 2 weeks. We're going to be looking at analysis through a very simple strategy and coming up with conclusions and potential trading opportunities. So what we're going to do now, I'm going to hand you over to Chris. And what he's going to do is go through a couple of pairs using the strategy and starting from the monthly, working our way down. He will be explaining to you the reasons why we do that, looking at the candlestick formations that are happening, because that's another thing that we need to incorporate within this week, is really taking advantage of looking and knowing and understanding those candlestick patterns. Once we've gone through those steps, then what we're going to be doing is asking you for a little bit of some feedback on some pairs that you would like to look at, that you would like us to discuss with you, some that maybe you've got on your watch list, some that maybe you're not too sure about, and any questions that you may have. So what I'm going to do is hand you across to Chris now. Bear in mind all the things that we've just gone through: our moving averages, our MACD histogram, our MACD moving averages, and RSI, as we go through to try and find some really decent trading opportunities if possible. We will then be back again for some questions and answers. So you will need to bear with me for a second. This is one thing that Chris and I have not really got a handle on with our new software, is changing the screens. It might take a minute, but we haven't lost you.
Okay, so everybody can see my screen. Most importantly, everybody can hear my voice. Okay, so in front of me, I'm just going to go over the four majors. So we predominantly stick with the four majors, and there's a reason why we do that. It's purely because there's more liquidity that is driven through the four majors, which is made up of US dollar, which is the fiat currency of choice. Then we have the euro, which is made up of 27 nations, as we know. And then we have pound sterling, and then we have the Swiss franc and the yen. Okay, so predominantly, most of the liquidity is going to be driven through those four pairs. And then what we do over time is then we tend to branch out. We can go to commodity pairs and then the exotic crosses that pair onto those. So I'm just going to open up the euro to start with. Okay, so just go through. We go through and just open up a pair. In this case, the euro against US dollar. We always start with a monthly time frame. Okay, I don't know if Nikki mentioned that, but the most important thing is we always start with a monthly time frame. We want to systematically break down the chart into manageable chunks, and at the end of it, depending on which time frame you're going to choose to trade off, whether it be a 4-hour, an hourly, or a daily for some of you out there who work a 9 to 5 or longer, by the time we get down to that time frame we want to do our trades off, we should have an understanding of what it is that price is doing, which will then allow us then to trade off those time frames more comfortably. Okay, so in this case, I have the euro against US dollar open on a monthly time frame, and it's just a default template. Okay, there's nothing fantastic about it. It's just a rudimentary candlestick pattern chart. Okay, onto this, I'm then going to open up the Forex Made Easy. So I'm just going to apply that just by clicking on this icon down over here and applying my FME template. Straight away, right off the bat, we have Forex Made Easy template applied to it. Okay, so now what we're going to do now is apply more time on the hard right edge. Okay, as Nikki mentioned to you, it all comes down to 3 individual indicators. Not a lot. At this initial stage, what we want to try and do is we want to acclimatize you to looking at the bigger picture, acclimatize you to actually being able to break down a picture, and acclimatize you to a point where you can actually understand what the chart is telling you before you can make a decisive trade. So in this case, what I need you to do is pay attention over here to where price is doing. Now, as Nikki mentioned to you, what we do is we first look at the moving averages. Okay, moving averages are trend bias. Okay, so in this case, on my chart, I have the 50 period moving average in a purple color, and my 200 period moving average, which is the institution moving average, is in green. So I want to know if I'm in a trend, because remember the two moving averages will act as either resistance in a downtrend or a supportive momentum in an uptrend. Okay, so straight away I can see right off the bat that if price is trading between the two moving averages, I have a indecisive period where price is going through a change in direction. So you can see over here that throughout 2018, 2018 started high over here, right through to the end of 2018, which is done to this point over here, you can see that we were actually in a negative move. Okay, but price was trading between the two moving averages. Okay, so here again, be aware that price is trading between the two moving averages in this case, which is a sign that we don't have a true long-term trend direction in this case. We do have an intermediate trend direction in this case, which is negative, but the long-term process is as long as price is not trading below the 50, then we don't have a case where we have a strong negative trend playing out. So in this case, if you are straight up on the monthly, I can see that price has been very consolidated here on the hard right edge. Now there are a number of factors. Nikki mentioned to you that support and resistance levels are also of importance. In this case, you can see that I can see multiple years. And you'll notice that over multiple years, at certain times, there have been areas where price has been consolidated, unable to move higher or unable to move lower over time. Now, what we want to do is we will need to focus on those areas because those areas will either, in the previous or in the past, act as either a resisting factor, which will then in the future potentially be a supporting factor, and vice versa. So you can see if I draw a line on the chart, a horizontal line, you'll notice that through 2015 and 2016, we saw a major seeding level. Okay, and that same level through those two previous years was a supporting factor once price broke above it in 2017. And back in 2018 is now another supporting factor role. Okay, you see that towards the latter part of 2018, we had an October candle which closed very negatively below the 50 moving average. So through October and November, price was trading below the 2 moving averages, which is a sign of negativity, because at that point we had price trading below both moving averages, which is a check for negativity. However, if we're looking for continuations of trend on that outcome, okay, on the creation of the October candle, November, December did not give us a continuation, because you can see both candles failed to continue to drive low sentiment. Okay. So over there we have a concern, because now you'll see that price at the moment now is reattempting and has closed. The December candle, you can clearly see, has now closed above the 50 moving average. So now we are sitting in an area where over multiple years we've had a lot of hesitation. So draw the line as thick as possible. Well, what I look and see this chart on the monthly time frame, it gives me a sign that I need to be more standoffish. I need to sit on the fence and bide my time, because at the moment now price is trading at a major support and resistance level that's been in play since 2015. So that's effectively 4 years in the making. Okay, there's a lot more risk attached to this chart right now because of where price is currently trading. Now there are a number of fundamental reasons that could have drawn this particular chart, but just by looking at what we have on the chart at the moment now, you'll notice that there's a lot of indecision that's crept into this particular pair. When I say indecision, if I just zoom in, you'll notice that the candlesticks have exuded a lot of wicks, shadow we call it, on a number of these months leading up to this period, which indicates that there's a lot of head bashing between buyers and sellers. Clearly, there is not one pair or one or the other that's really in who's actually dictating current market trend. Okay, so that's another side. Okay, now we look at the RSI. Like you mentioned, look at the RSI, which is the relative strength index. The RSI is made up of 3 parts, as Nikki mentioned. You'll notice that if it's trading below the midpoint, which is the 50% level in this case, then we should be looking for negativity on the actual candlestick formation. And if it's trading above it, then obviously we should be in a positive position. In this case, you can clearly see that the December candle closed higher than the 50-period moving average and closed higher than the November candle. So now you can clearly see that we have an intermediate support mechanism being formed. So we have, especially from August, September, October, November, December, 4 consecutive months where prices failed to make a new low to the downside. So now if there's no continued selling coming through, then what does it tell you? If people are not selling, then they're obviously not on the market. But you can clearly see that people are not buying either, because price has not really moved to the upside. We can, however, see that the December candle, we saw initial buying coming in, but not enough to actually close above the previous candle, which was an indecision candle, okay? A doji. Doji in Japanese terms means indecision. So if you see an indecisive candle on the chart, it tells you to rather stay in order. Don't get involved, rather sit on the sides and wait for a decision. Okay, so in this case, if we haven't had a new low for the best part of the previous 4 months, then we could see less euro sellers and more euro buyers. Now, fundamentally, we could also see weakness in the dollar because of interest rate hikes, 4 consecutive interest rate hikes, etc. You could look into that on your own time, but you can start to build in more of the fundamental side of things, looking at the bigger picture. So over here, if we are indeed seeing euro bulls, then we need to see a candle closing higher than the previous doji candle. Now, the December candle attempts to close higher than the November candle, but failed to do so. So looking ahead, as we head into the first month, first quarter of this year, if this is indeed a period where we are likely to see a greater retracement against what we saw, selling momentum we saw throughout 2018, on an area where we've seen a lot of support and resistance in the past, we need to see price trading higher than the November. So the November candle high. Then we can then look for an opportunity to the upside. Okay, the MACD, momentum. Okay, momentum is important. If we have a trend in place, we need to see momentum. If we don't have momentum, there's clearly no trend. Okay, in this case, you'll notice that moving averages, the fast line is below the slow line, which is a negative sign, and the histograms are below the midline themselves, which is a negative sign. However, you'll see that the histograms have not made new lows, which indicates that there is no continued selling momentum. Okay, so you can clearly see that the MACD is also reflecting what I can see here on the chart, which is important. So now when I drop down to the weekly now, I know that I have consolidation because the best part of 4 months, especially the last 2 months, has not gone anywhere. So we should be seeing consolidation on our lower time frames. That will be replicated, especially on the weekly. Look at that weekly chart, guys. Price has done absolutely nothing for quite some time. Okay, just going to take this off. There we go. So you can see clearly that price is stuck within this conservative band for quite some time. Now, as long as price is trading within this band, we do not want to trade. We will only look to trade this if she gets out of this box. Okay, rectangles are quite important. I use them all the time. It gives me an idea that it stops me from taking trades where I don't see continuation. Here you clearly see we've had multiple, almost 8 weeks where prices failed to make a new high or a new low. Notice, however, that on the weekly time frame, the 200 period moving average is also acting as a strong support mechanism and has done for most of 2018. Here again, if we are in a strong trend, both moving averages should be either above price resisting her or below price supporting her. Notice price is trading in between. So we don't actually have a strong trend. Okay, we've seen price falling throughout 2018, but not with a lot of genuine momentum flow through. So there's been a lot of apprehension with this particular pair. We could look at trade wars, we could look at Brexit. These are uncertainties, which creates uncertainties within price action, which creates this volatile domain between buyers and sellers. And that's clearly what we've seen throughout 2018. So now, straight away, you can see that if I'm looking for continued selling, which is what's happened throughout 2018, I would need to see price closing lower than the current consolidation before I actually look to re-intervene into this particular pair. I know that my long-term goal could always be the low that we saw through 2015, 2016, and the start of 2017. That is in excess of 887 pips, give or take. Okay, so there's a lot of bang for buck if indeed we do see continuation. Now we've got to look at the fundamentals as we head into the uncertainty with trade wars, with Brexit. That could lead to further uncertainty, which could then push price low. Having said that, we're also seeing a tightness within the US market because of the interest rate hikes, etc. That in itself could also lead to further turmoil for the dollar down the line, but that's to be seen. Okay, so now if you look at the RSI on this particular chart, you'll see the RSI is below the midline. So that's a sign that there's negativity. But notice, however, that the RSI, even each time that the price has tested the same level over time, the RSI has not weakened. It's actually strengthened. So now the RSI is actually working as a multi-tool. Now it's telling me that I have convergence taking place, which is a sign that there's clearly no genuine sellers currently in the market. So another reason why to rather stand aside and wait patiently before we get to see if we do get that continuation. Another sign, if you look at the MACD, when we have trend in place, if I just zoom in, I can show you that. When we had the movement over here, for example, you'll see that the MACD below gave us a really good sign of momentum, and the histograms were complementing. Notice over here, however, through this period where we've seen a lot of uncertainty over the last 6 months or more, you'll see that the MACD is flat. It's gone higher, lower, it's crossed over multiple times. That indicates to you and I that there's no true momentum, directional momentum in this case, which is not what we want to see. Another sign that we should be standoffish. So just by looking at 2 time frames, predominantly starting with the monthly and then working on to the weekly, I know that if I'm to trade off my daily time frame, I'm trading within a consolidation, which is high risk already. Okay, you don't want to be trading in a period where you see consolidations for long periods of time on your larger time frames. That should stop you straight away from taking trades on your daily, your 4-hour, your hourly, or heaven forbid you go down to a 30-minute or 50 minutes. Okay, so what I've done on this particular pair is I'm looking for a breakout continuation to the downside, which would then continue the sentiment that we've seen throughout 2018, or if we don't see any continued selling and more bias comes in, I need to see price closing higher than this current level, which would then allow me to look at a previous consolidation area, which was this particular point through here, which takes me back to my 50-period moving average, is my initial target to the upside if we do get a close above it over the coming weeks. Okay, so that's the euro against US dollar in a nutshell. If I go on to the pound against US dollar, here again, open up and make a chart. We're starting with the monthly, as you'll see. I want to apply my Forex Trading template to this time frame. And now what we do is systematically go through the same rules-based system that we did with the euro against US dollar. Now you can see on this particular pair, we have the similar trait. So you can see these two vertical lines over here on the white. That represents 2018. I'm looking at a monthly time frame, so each of these candlesticks represents 1 month. So there again, you can clearly see that the start of last year, January, February, March, and April, we failed to make new highs. We were stuck on a consolidation for a while before we started to see a sell-off. Okay, which led to price falling systematically over most of last year. Having said that, notice that there's a lot of wick, of shadow, I like to call it, on each of these candles. Notice on a lot of these candles that there's a large trading range. Now, if you look at the pound, you'll notice that there's a lot of risk attached to it currently since we've had Brexit thrown at us. Okay, and we're now closer. We have to, by March of this year, if I'm not mistaken, have some sort of deal on the table. Otherwise, we walk away with nothing. And because we are we don't really know what the deal is. Theresa May is trying to sell us a deal. Nobody really kind of likes it, and that has led to a lot of apprehension amongst buyers and sellers out there, which has led to these candlesticks that you currently see. Notice as we've got closer and closer to the end of last year, the more wickier the candles have become, the more uncertainty is in the market, okay? Which is not great for you and I, because that tells us that there's a lot of speculation taking place, and it'll lead to a lot of volatility. If you look at each of these candles, we're looking in excess of 480 pips on average. But you'll notice that there's major pullbacks. So we saw a lot of buying at one stage through the month of November. However, all that was taken away by the end of the month. Then in December, we saw a lot of selling initially in excess of 350 pips. But by the end of December, we saw everybody taking profit and price moved back up again. So this volatility is something that we don't really want to be part of, because it's not clearly giving us a direction. Okay? We do have some sort of direction. We have a selling momentum at the moment. Now we are moving from a high point to a low point, but you'll notice that there's a lot more volatility creeping in. And overall, we haven't seen a close lower than the August low, and that's a concern. Okay, so now there's a lot of apprehension on this particular one. And another reason, just by looking at this chart, that if you look at what euro represents at the moment now in terms of the risk side of things, and you look at the pound and you look at the risk side implication fundamentals applied to that, if you're looking to trade these two particular pairs, you're doing so knowing that there's a lot more risk attached because of what's happening within the European Union. The euro, we look at Brexit overall, but you've also got Italy issues, within other aspects of the European Union as a whole. When you look at the UK, we've got Brexit as the major one. Then we have trade war, etc., and all the other implications that go with that. So there's a lot of risk attached to these two currencies due to those two fundamental issues. That's what we're seeing currently taking place on the chart. If you look at the RSI, the relative strength index is pretty much moving as requested on the chart. If you look at this particular pair, and the two moving averages are above price, where if you look at the euro against US dollar on the monthly, you'll notice that price was trading between the two moving averages. So in this case, the pound has a stronger negative picture because of the fact that the 50-period moving average and the 200 are still above price and resisting. There again, the RSI is also below the midline and negative. The MACD is below the midline, fast line is below the slow line, and the history are tracking below the midline, which is also a sign of negativity. Having said that, you'll see that the MACD is not making new lows. Zoom in. You see the MACD has not made new lows since November, which is a sign that we don't have continued selling sentiment coming through. But there again, if you look at the candlesticks, they're not showing us any continuation because we haven't made any low. It hasn't closed low. Okay. So now I know if I look at down on the weekly, I should see a lot of volatility. Okay, if I drop down to the weekly, there we go. You can see a lot of small candles with a lot of wick. So you'll see that the mindset of the trader on the pound cross in particular is one where they're applying a very aggressive measure to the trading. They are all speculating, so they're all going to be looking at the pieces of data that come out on a day-to-day basis, whether they're coming out of the House of Parliament, the House of Commons, or just in general, and they're just literally trading on those pieces of information because there's a lot of data coming out in terms of what Theresa May is wanting, what the Conservative government wants, etc., etc., etc. All these things are coming in, which is leading to a lot of guys out there who are just speculating on what the outcome is likely to be, which leads to a lot of volatile moves within small ranges. Okay, you can clearly see this taking place. Yet another reason why this particular pair is one where you should far more likely be standing aside or sitting on the fence, is another word, and waiting for a more decisive continuation, where you need to see a stronger candlestick formation on the weekly to emphasize continued selling or buying in this case. Now here again, you'll notice that the RSI, similar to what we saw on the euro against US dollar, you'll see that the RSI over here, you see prices have been falling, but the RSI has been moving in the opposite direction. Okay, so that indicates to you and I that there's convergence taking place, which is telling us that there's less genuine sellers on the hard right edge than there was on the initial move to the downside, which is a sign that we need to be cautious at this particular point. Because if there is to be genuine selling, we need to see the RSI moving lower to indicate that there's true reflection of relative strength of price action. In this case, we don't have it. Another reason why we need to be vigilant. Another one over here is you look at the MACD. The fast line currently trading slightly higher than the slow line, and this is trading slightly higher as well. Okay, and we're starting to see convergence as well on the MACD, which is another sign that we're seeing more pound strength currently against the US dollar. Okay, so a lot of volatility, one that we might need to be more standoffish for the time being until we start to see more coming out. And remember, it's not that I think they've actually set a date where they're actually going to be, the members of parliament are going to actually be voting on Theresa May's new deal. So there again, I think it's in a week's time. So I think a lot of traders will be standing aside until we actually get a viable outcome on that vote before they actually start to trade this one. So we might see a lot more volatility or small movements in this particular. Okay, so let's move on to the US dollar Swiss franc. There again, starting with the monthly time frame. Okay, straight away on this particular pair, without even opening the FME, you can see that this particular one has been, headbutting along for a long period of time. You can actually draw a line in the sand here, and you can see, notice that over time, this goes back to 2008, funny enough, you'll see that price has been hesitant along this line for a number of times. Okay, if I apply the FME to this, you'll notice another thing where you'll see how the 50 pair moving average has done a fantastic job in the past of resisting price, but recently over the last 1, 2, 3, 4 years, we've seen the 50 pair moving average acting as a support mechanism. So if I just zoom in now to the hard right edge, you can see here again, this particular pair is trading slightly above the 50 pair moving average, but it's trading lower than the 200. So here another indication where we have another pair where price is trading above, in between the two moving averages. So in terms of a trend direction, you can see that this one has just been flatlined. If you look at the bigger picture, it's just been going sideways. Okay? Not really great, not all that great for trading particularly, which is a concern because this one over here would probably be the last one that I'll be looking at in terms of the four that I look at. So here again, I know just by looking at the bigger picture, I'm trading a pair which has just recently found or traded back into resistance, which was a previous support mechanism. So there again, I'll be playing caution to the wind because I'm trading into a ceiling level. Okay, as I noticed to you that the dollar has been very, very strong. We've had 4 interest rate hikes through 2018, which is a positive sign on the US market. And we've seen a hell of a lot of growth in the US market over 2018. The non-farm payroll figures that came out last week Friday, which is an important reading. First Friday of each month, we have non-farm payroll figures out of the US. They came out twice as high than expected. So they were creating twice as many jobs than they expected they were going to, which is a strong sign. And the average hourly earnings figure was also indicating that there was money being really given to employees. So businesses were making profits, and those profits were then passed on as incentives to the employees, which is a good sign. So we have liquidity moving around. Having said that, now we've had 4 interest rate hikes. We're starting to see lending and borrowing becoming more expensive because interests are higher. We could see that playing out through 2019. So that could, we could start to see a bit more dollar negativity because of that. So we've seen price retracing off the highs, but you'll notice that price is trading now at the 50-period moving average. Okay, so I need to, I'll make a note of that, because if I'm to see negativity, because price is really trading below the 200-period moving average, if I were to see further negativity, I would need to see price closing, trading and closing below 50-period moving average to then give me a positive sign that I should be looking to sell the dollar against the Swiss franc. If that's clearly the case, then I need to see the RSI below the midline. You can see clearly right now it's trading on the midline and flat. Okay, so there again, I don't have a genuine reflection of what I'm seeing in the chart above. So therefore, another sign I need to be paying cautious to the wind. If I'm looking for selling over here at the top end, the price is telling me that, you can see that the MACD is still not giving me that momentum. But there again, we're not in a trend, okay, which is a concern. See, prices just gone sideways through most of 2019, which is not a good sign. The fast line is still above the slow line or the trigger line, and the histograms are still above the midline. So we get a lot of signals here which are mixed, which is not a really good thing to see. Okay, which is here you can see the RSI, that's still positive. MACD still positive. Okay, even though we've seen price falling. 50-period moving average over here is the concern. What I need to see now is I need to see price closing below that level before I actually come up with any opportunities to continue to sell this. So if that's clearly the case, what I need to do, that is I need to now, is, oh, yeah, there we go. So drop down to the weekly, and then you'll notice that when I drop down to the weekly, I'm looking for the price to be trading below that level. You can see that I have my 50-period moving average and my 200-period moving average below price at that particular point. So another reason, there's more risk now with traders than trading into a particular point where we could see price hesitating. Okay, you'll notice that the RSI is trading below the midline and getting stronger to the downside. The MACD, fast line's below slow line, histogram is getting stronger to the downside as well. Therefore, indicating that we should be looking for selling. But you'll see that the last 2 weeks, price traded into the 200 and the 50-period moving average, but then pulled back. This week, what I'm looking for over the next 5 days, 4 hours, and 9 minutes is I want to see price closing below this level before then I can start to look at this particular point that we saw here in September as a viable target, which is in excess of 186 pips or so, which is more than enough, not a decent return on time invested. But I will only do so once I get a viable close below this particular point. So that's going to be my trigger level for this week. I'll sit aside, wait patiently, and look to see if price can get below that, close below that, and then I can trade with more certainness and more probability and less risk that price is then going to fall down to this particular point. Get below that, then my next target would be the level that we saw here way back the start of the year in April, which is another 319 odd pips to that. So there's a lot on here in time invested if we do get a viable close low over the next couple of weeks. Let's go to finish off with the US dollar Japanese yen. So there we go. Apply the US dollar Japanese yen to the charts. Okay, I'm going to apply my FME to this, and let's have a closer look here on the monthly time frame. This one over here, you can clearly see that throughout 2018, price was moving to the upside. At the moment she headed into the 2017 resistance level highs, price then gave us selling sentiment, sell-off, particularly through January. We saw a lot of selling momentum. Recently, there's been a lot of things mentioned, such as Apple, which is a major impact on the Chinese market, which has had a major impact on the Asian side of things, Australia, New Zealand, and Japan in particular. And that's had a noticeable sell-off. Okay, so here again, huge bearish engulfing candle in December, and you can see that at a ceiling level, which is then indicated that we should be looking for selling sentiment throughout January of this year. I mean, our first target would have been down here towards the 200-period moving average. You can see so far this month, price is exactly that. Tested the low that we saw throughout 2018, but also the 200-period moving average, and subsequently we've seen a major pullback. Okay, if you look at the moving averages, you'll see that the 50-period moving average was also a ceiling level, and you'll notice that another one of the four majors, price is trading between the moving averages, where in an ideal sign of strength, where it'd be a positive trend or a negative trend, price should be trading below moving averages or above moving averages to indicate. Here you can clearly see the price is trading within those moving averages. So just by going on what we saw on the December candle, a nice bearish engulfing candle in excess of 400 pips with very little wick. Okay, when you have a candle that does not show any shadow, okay, wick on the other side, that tells you that from the word go throughout December, everybody was doing nothing but selling against the yen. Okay, which is a strong emphasis that we should see continued selling emphasis on the next month, which is clearly what we saw throughout this month. A lot of selling, and it's an equal driver candle. So the December candle gave us a 420 pip move, and we saw a 435. So pretty much a replication of the December candle right off the bat. Now we've seen a major pullback because of that. Okay. Looking ahead, if price fails to close below that, then ultimately what we could be doing is seeing price following the same rule of just engagement, just trading within this consolidation band. So know that there is clearly a risk trading something that's consolidative. If you look at 2017, a lot of wicks, okay, which emphasizes that there was a lot of movement between the high and the low of the candle of that month, but you can see that there's a lot of wick, which emphasizes that there's a lot of retracements, speculative volatility, highs and lows within that month, which is not really what we want to be trading or get forward into. So here again, I'd like to see this month closing lower than the December candle, which would then emphasize that we should be looking for continued selling through February, March, and April. Then we could start to look back down towards that 200-period moving average as the viable target for the foreseeable future. The RSI is tracking below the midline, which is a negative sign. The MACD, notice that the blue line is still above the red line, which is the fast line is still above the trigger line, and the histogram is still above. So we don't have momentum. In this case, selling momentum, genuine selling momentum. Okay? It's just because it's trading within a major long-term consideration, a far bigger consideration. Okay, so if I drop down now to the weekly, you can clearly see that we have price trading below the 50-period moving average, which is a negative sign. Price trading below the 200-period moving average, which is a negative sign. The RSI is tracking below the midline, which is a negative sign. And the MACD, fast line below the slow line, which is a negative. And the histograms are below the midline and getting stronger, enforcing that there is continued selling. Notice last week's candle, you see a lot of sell-off in excess of 530 pips, but we saw almost a 60% retracement within that. Okay, that's a concern. Okay, what I want to see this week to back up potentially continuation of that selling is for price to continue to make new lows. And currently, as you can see, the candlestick currently for this week is black, not filled in. That means it's trading higher than the close of last week, which is a concern because I'm looking to sell. Can't have price going in the opposite direction. Okay, and that becomes more apparent when you drop down to the daily. So there you go, and you can see it. We saw Wednesday candle last week, then we saw Thursday and Friday moving against the trend, and then Sunday evening, and then you see Monday. Okay, so price needs to be trading below this particular point over here to then tap into that, i.e. trade back down towards the low of the candle we saw Wednesday last week as a viable target. So I'm going to wait patiently for price to cross back below here. You can see my 50-period and my 200 are above price, which is negative, which is good because it tells me that I'm still in a negative trend. You can see the RSI is below the midpoint. Okay, came out of 30% level, which was oversold. Nikki mentioned to you, if things are oversold and price gets above it, then we should be looking for buying, and you can see clearly buying took place. But you can see it's flat at the moment. But price is also flat. Has not made a new high since the close on Friday. The MACD, fast line's below the slow line, histograms are tracking below the midline. However, having said that, prices moved through Thursday and Friday and Sunday up. You can see the histograms go weaker. So here I'm just playing caution to the wind. I'm going to wait for price to then find the momentum to drop back down again. What I need to do then is to look at the economics for this week, Monday, Tuesday, Wednesday, Thursday, Friday, look to see if there's going to be any dollar data out, which is going to be of importance to this particular pair, or yen data on the Asian session. Look to see if there's any negative data, which is then going to push the dollar lower against the yen for this week. And if I do get that, we're starting to see signs over here, especially for today. We have the signs that we could be looking at a hangman candle on the resistance level, which is a sign of negativity. Okay, she doesn't make new highs. And what we want to see is through Tuesday, Wednesday, Thursday, Friday, the bearish engulfing candle. If she close below the low or the close of Wednesday's close, and ultimately we should be looking back towards that level down at 105 triple one as a viable target, which is in excess of 200 pips. Okay, I hope that's helped, guys. I think Nikki's got some questions.
Hello, can everybody hear me? Right, so I hope you've got to see how FME works in its entirety. That it's a very simple strategy to use, but it gives us very clear results, and that's exactly what we're looking for, to keep things as basic as possible for these first 2 weeks especially. So I want you to bear that in mind as we work through the course. Our evenings are obviously going to be looking more at the longer term time frames, looking for daily closes and things like that. So as we progress into our next evening session, we're going to be looking for daily closes for Thursday morning trading. And in the mornings, we're going to be looking at the overall picture from the monthly right down to the intraday side of it as well. Because obviously we don't want to be taking intraday trades at this time of night. We've been having a look at the chat here for a little bit. I can see that we've got the New Zealand dollar, US dollar as one of the watch pairs from one of the students, and US dollar, Canadian dollar. So I think what we'll do is we'll have a look at the New Zealand dollar, US dollar, and I think depending on the time, I'm just conscious that it is nearly 8 o'clock as it is. But let's have a look at the New Zealand US dollar. And then I will put into the chat box, I've got 3 pairs on the watch list. They're not 100% looking great, but they're certainly going to be ones that I'm going to be looking at tomorrow and ones that I'm going to be discussing with you tomorrow. So it'll give you a good opportunity this evening to have a look through them. We have been going for an hour. Anything could have happened to them in the meantime, but it's certainly something that you can go away and do as your homework and preparation for tomorrow. So one more thing, let's have a look at the New Zealand dollar, US dollar. I think, don't know who mentioned it, I think it may be Henry. So we'll look at this and then we'll close up for today. I will be sending you through an email this evening with your registration link for tomorrow and a couple of things that I want you to bear in mind and put together over the course of the next couple of days. Right, so I'm going to hand you back to Chris.
Okay, I hope you guys can hear me. So, here again, I've opened up the New Zealand US dollar chart. I've applied my Forex Easy template to this chart. And remember, we always started with the monthly time frame. Always start with a bigger time frame and work our way down through the time frames towards the time frame that you're going to trade off. Okay, so here again, notice here on the hot right edge, you can see through 2018. Okay, I'm looking at where prices now, where she's come from. You can see that we came from a high point, we moved lower through 2018. But towards the end, the latter part of the year 2018, we saw November moving higher. So what I'm looking for now is I've got to then have a look to see where price is trading in terms of the major support and resistance levels. Okay, if you look over here, you can clearly see that we had a lot of consolidation through 2017 and 2018, and price traded into those levels towards the latter part of the year. Above that, we had another consolidation point over here on this level over here, and below all of this, you can see that we had a consolidation in 2015. Notice that we weren't too far off those levels when we were trading through 2018. Okay, The two moving averages. Okay, as I mentioned to you, the two moving averages are going to be trend bias. Notice where price is trading in conjunction to the 50 and the 200 below them. So that's a negative sign. Okay, so here again we should be looking for selling. But you'll notice that the last 3 months of 2018, price is moving in the opposite direction. Okay, which is a sign that we need to be paying caution to the wind because we don't see any further New Zealand negativity. Okay, we also trade into the price support and resistance level that we saw throughout 2017 and 18 as well. So there again, pay caution to the wind because of that level. The RSI is also trading below the midpoint. Okay, that's a negative sign. Okay, so we have the moving average above price, which is a negative sign. The RSI is below the midpoint, which is a negative sign. Okay? The MACD, fast line is below the slow line or the trigger point, and the histograms are below the midline, which is also negative. But you'll notice that over the last 3 months we went up. You can see the histograms have got weaker. So here again, if I'm looking to sell this, price is not pretty much going in the right direction. You look at the current candle. Last December candle, we actually saw a bear candle coming off the November close. But you'll see that this month, the January candle, we were trading lower than the December candle by in excess of almost 125 odd pips. But you'll see that price is now trading above the close of December, which means that we are going in the wrong direction. Now, as I mentioned to you, this particular pair is an Asian cross. It's a commodity cross. We talk about this in more detail in the course, but it's a commodity cross. Therefore, it's reliant on a lot of its commodity exports, but it's also reliant on a stronger Chinese economy in particular because it's an Asian, New Zealand is part of the Asian market, and because we're seeing if you look at the fundamentals, we're seeing a slowdown in the Chinese market. That's going to have an impact on any economy out there, which is providing a resource to a larger entity, which is the Chinese market. Chinese spend less because they're not getting orders from us here in the UK or the US or anywhere else in the world. That then is going to play an impact on those economies who are providing a raw material or a product to them. So they spend less. That means they're not getting orders through Australia and New Zealand, and you're going to start to see that playing out on the economies. Okay, so here again, we've got to keep in mind that if I'm looking for selling, I need to be trading lower than the December close, which means I need to be trading below that particular point over there. Let me just draw a straight line. Great. So now if I drop down to my weekly, I need to see price closing below that, trading below that particular point to emphasize an opportunity to trade with direction. Drop down to the weekly, and you can see that last week's candle created this hammer formation, which is a bullish sign. Okay, in the 2 prior weeks of that, we didn't see any lows below that, so therefore I need to be cautious because I don't see any continuations at the moment now, which means that there's more risk at the moment. Notice, however, that my 50 and my 200 period moving average are still above price, which is on a negativity. The RSI is still below the midline, even though it's flat, it's still below the midline, which is a sign of negativity. My MACD, if I'm seeing selling momentum, I need to see MACD negative. In this case, it's positive because the fast line or the blue line is above the slow line, and my histograms are above the midline. So my momentum is not in favor. Okay, I do have a hammer, and this is a representation of a bull setup, a buyer's setup. If that's clearly the case, then I need to see price trading higher than the close of last week or the last 2 weeks in particular. So I draw a line above the high of that, get a straight line of some sort, take that, let's drag it down. And if I drop down to the daily, if I can get above that level and close above it, then I could be looking to this high. But if that's clearly the case, as I mentioned to you, you can see that price has been falling on the daily. Okay. Notice that price is trading above the 200, which is a positive sign, but it's not trading above the 50 period moving average, which is not a good sign. Because if I'm in a trend, I need both those moving averages below price supporting her in an uptrend, and vice versa. In a downtrend, I need them to be above price. Clearly, price is currently trading in between them. So there again, I know that if I'm looking to buy this, there's a risk. Okay, there's a 35 pip risk of holding this particular pair. So now, it's the reason why it's important that this week, if this is indeed a sign of positiveness, a hammer, remember you only pick up a hammer to build something. One would say you could use a hammer to break something, but in most cases, in candlestick formations, a hammer represents a positive sign of building. Therefore, if I'm looking for building, I need to see signs of that building taking place. So this week, I'll be looking for signs on my daily, Monday, Tuesday, Wednesday, Thursday, Friday, of this week, 5 days, consecutive days. I'll need to see buyers coming in to then build up the momentum that the weekly candle, the previous weekly candle is telling me that there's buyers around. So if I don't see any more buying this week, then clearly that weekly candlestick that was formed, which gave me the hammer, is a representation of just profit taking, a retracement, because people are clearly just taking profit. Okay, so this type of thing you'll start to pick up as you head further and further into the course material. But candlesticks in particular is something that's going to help you in the long term as well. So I'm just looking at what the weekly candle is telling me over here, which is telling me that there's clearly a bullish stance taking place. I'm okay for that, but I need to see that playing out this week. If I don't see price making new highs, not getting above the 50-period moving average, then I clearly don't have a buyer's market. Therefore, I'm not going to then risk taking a buying opportunity if there's clearly no follow through or buying follow through in this case. So this one over here, I'm going to play caution to the wind again. Remember, it's the start of a new year. Liquidity is still got to come in. Remember, a lot of these fund managers and portfolio managers, etc., like that, are going to be still in the infancy, still looking to see where they're going to be applying their markets trades to. But they're also going to be looking at the bigger picture, trade wars in particular. Because New Zealand and Australia are dependent on the Chinese market. If China's having a trade war at the moment now, and they're being constricted in terms of exports, that's going to have a major impact on any Asian economy, which is providing a resource or a third-party direction to that greater economy, which is going to have a negative impact on Australia, which is going to have an impact on Japan, which is going to have an impact on New Zealand. Okay, so I don't want to be buying something if in the next, or the second quarter or third quarter, we could start to see a greater contraction because of the trade war, which could then lead to New Zealand pretty much falling away. So I don't want to be buying just on a whim. Okay, all these things need to take place, and I'm going to play caution to the wind to get a stronger picture of that happening before I take any further opportunities. I hope it's helped, guys.
Right, guys. I hope you enjoyed this evening's session, as I've just been writing out a script there for you in the chat. The idea is to take at least these first 2 days really slowly, going through in detail the formations of candlesticks and how they can affect our trading decisions, having a look at the strategy, taking note of the fact that RSI might be flat and that there's no momentum coming through on histograms, because they all boil down to give us that final result. And in order to put a higher probability in our favor, that's exactly what we need. So, as I said, the evening sessions are going to be more towards daily closes. So from Wednesday, it is Wednesday, yes, Wednesday, we're going to be looking and placing alerts on daily closes on pairs that will hopefully be in better positions for us than what they are today. And from Thursday, we'll be looking at setting intraday trading opportunities. I mean, if tomorrow we do get that, then we'll certainly have a look at it. But what we're wanting to do now is take that longer term that we've done with you this evening and then start to bring it into the intraday time frame as well. So you've got the opportunity to decide what time frame that you want to trade, which again becomes part of your plan. So I hope you've had a good evening with us. It's great to be back. And great that we didn't have too many technical problems, which is a big thing for us, because that's generally what happens. I will be sending out your link within the next 10 minutes or so for tomorrow morning's session. We look forward to seeing you then. Have a good evening and catch you then. Take care.